Hello, chart watchers and Decision Point faithful. Welcome to this Monday, March 30th, 2020 Decision Point show with your hosts, Carl and Erin Swenlin. For those of you joining us for the first time today, we want to welcome you to the show. And for our regulars, of course, welcome back. We have a lot to cover. It's been a very interesting couple of weeks, and Carl and I have lots of interesting information to share with you. We're going to start off with looking at some bear market technicals. We're going to check out our earnings chart so you can see, are we really looking at bargains or not right now? Real estate, we're going to cover a lot of that sector. Carl's got some great charts. And then we'll finish. I'm going to talk to you a little bit about depression versus recession, because both the recession word is being bantied about, but I don't see a whole lot of talk about depression. And I think we need to look at the differences and consider those. So I am going to welcome you in. How are you doing today, Dad?
Okay. Well, I'm recessed, but I'm not depressed yet.
Okay. Yes, I know I have receded, and unfortunately, not my waistline. That's for sure right now. All right. Well, it is a pretty day today. We're getting some sunshine down here in Southern California, which is nice to see. But the market still is looking pretty interesting. So why don't we go ahead and let you go ahead and share that screen and show us what you're looking at right now as far as the S&P 500, and we can chat a little bit more when the chart's up.
Okay. Well, starting out with just the 4-month chart of SPY. There's a lot of interesting issues on this chart, really. If you remember this rising wedge over here, that was quite a bit larger. Not as big as this falling wedge, but it has receded into obscurity at this point. This area of the chart looks, when you're just looking at it without thinking about the size of the moves, it looks like a normal chart, but then the moves in here are just huge in each direction. Like on Friday, you remember, that was a pretty big, bad down day, but when you put it in the context of what we've got here, it doesn't look so bad at all. We've got a breakout trying to go here, and we could see a breakout above the declining stops line. If it happens, I don't think it's, it could very well happen. I've been around a long time, and I've seen these kind of fake out moves, and we're certainly getting set up for one here, it looks like.
Yeah, I have to agree. Did you notice the VIX today? I know that's at the bottom of the chart.
Right.
Finally seeing it above that average on our inverted log scale. Right,
and it still can't get where people aren't worried anymore, can it?
No. Even if it hits that top Bollinger Band, we're still talking about a reading of over 30.
Yeah, so, it's still way.
That volatility. What are you making of that, the total volume, though? I know that for me, seeing that.
It's falling, Yeah.
I don't like to see that on a rally.
Yeah, it's still above the, this is the average, the 1-year average of total volume for the S&P 500, that line there. So it's still well above that, but each one of these up moves, well, even it's just losing volume, and doesn't mean it's all over with. But if it broke out and it just notched down again, that would not be particularly helpful.
No, not at all. I'm going to steal the screen real quick, and I want to give people an update on our signal changes that we've had today, and then also look at some of the sectors, just the sector overview.
All right.
So I'm going to steal it, and let's go back here. And you can see that today we had 4 new buy signals on the major indexes, and actually there's another one on IJ H, which is the S&P 400 ETF. So we had 5 new PMO buy signals come in, and you know, I mean, that's positive, but it makes sense given that little, you know, the rally that we've seen, that we would see that change. The sector scoreboard hasn't changed. These are intermediate term trend model signals and long-term trend model signals. These are based on 20 and 50-day EMA crossovers. These are based on the 50 200-day crossovers. And as you can see, we're still very, very much in the red. I'll have to look at that XLK chart, so we'll take a peek at that, but I wanted to just show you something really interesting I'm looking at as far as all the sectors. Now, you can get to this chart from the sector summary, and underneath gives you some interesting information. You can also go and look at them in a candle glance. But what I wanted to point out is just what's been going on in you know, the past month, basically, a 20-day look. And where are we seeing the action? The only positive action is coming in our 3 defensive areas. And so typically in a bear market, when you get these rallies, if they're really concentrated in these defensive areas, you know, that tells you that the bear market may not be finished up yet, because you really want to see these not necessarily underperform, but you want to see these aggressive sectors like technology and discretionary. We need to see those starting to take the lead, and we're just not seeing that yet. The financials are hurting, and of course we know what's going on with energy. It's pretty ugly picture there. But let me go ahead and show you very quickly those signal changes that we had. Actually, there's what I need. So we'll look at the Dow chart really quick. I'm just going to point them out. There is that buy signal. You've got also on the NASDAQ 100, you can see. And I have been putting on the Fibonacci lines lately. Mainly, I found it very interesting because when you get a V bottom chart pattern, the execution point for the pattern is right at that 38% mark. And when it gets over that, if it can leapfrog it, the expectation of that pattern is to see it continue up toward the top of where that V was. Now, I am not going to say if we beat this 38% that we'll see that, because under bear market rules, you should expect bearish conclusions to your chart patterns, even if it's a bullish pattern. And there's the OEX real quick. And you can see that buy signal. And then we have also the S&P. And again, I put on those Fibonacci lines, and you can see that right now it really does seem to be an area of possible overhead resistance. Of course, it also lines up with that 20-day EMA, and I know the EMAs are also tend to be very strong overhead resistance or support, depending on where you are sitting with it. And then just a quick look at IJH, which is our S&P 400 ETF, and there you go. You can see that new buy signal that's come in on it. And then the last one I was going to show, what was I going to show last? Oh, XLK. Got to remember what I'm doing here. All right, XLK is the only one with that long-term trend model buy signal. That's because the 50 is still above the 200. Now, if we want to see that avoided, the tech sector here, we need to see it get up at least above the 200-day EMA. That would prevent the 50 from getting below it, but we really want to see price above that 50-day EMA, and that's where you'll start to see it start to curve back up. But we're not seeing that. And so that was really what I wanted to talk about as far as the sectors go and our new signal changes. So I'm going to turn it back over to you, and we'll look at some more of your charts.
Okie doke. See how fast I did that this time?
I know, we're getting you nimble.
One other thing I wanted to point out about charts in general, they give you context. I don't know how anybody operates without charts. It just makes no sense to me. But because you can see the trend, you can see the huge moves that we've had. You know, so that one day, one good day, one bad day doesn't stand all alone. You have, you get to see everything else that's gone on around it. Okay, that's what I wanted. Next, more context. See, in order to get back to the new highs, it has to rally 55% from this low. That's really a bridge too far, in my opinion, in any world. But now we've rallied 20%. That would not, we would be looking at this as a possibly a bull market if that were close to close. But I think that I would have to for it to be close to close before I would even start really thinking of it as a bull market. But even if we get a breakout here, and as I said, I think could happen, but that's just not going to change my mind about that we're in an epic bear market. That's all I can say on that.
Yeah.
It's not
I
all
totally
I can say.
agree.
I'll be saying it over and over
Yeah,
again.
I know. Well, everybody will know when we start to get bullish.
Right.
We're always bearish. So
Yeah.
as we say, when we're in a bull market, we have to sort of think in a bearish tone. And now that we're in a bear market, now we're starting to try and look for bullish signals. And we keep finding some somewhere. But we were talking about it earlier before the program, and so many people want to believe that this is the market bottom. So many people have been talking about bargains, dollar cost averaging, all of those things. And I just don't see it. We still have a lot of unknown out there, and the market, as we all know, is not happy with the unknown. I do believe there's still going to be sectors and industries that you could still grab a few winning investments from. That's kind of where I'm looking at with my diamond reports. But overall, I mean, you have to really be, we were just talking about being nimble. You really have to be that way and be able to watch it, and like a hawk, you really need to be paying attention.
I got this up here, a zone of resistance, rather than drawing individual lines across various points where we might see resistance. There's a lot of congestion in here that could actually end up stopping the advance, but that's what that's up there for.
Yeah, I mean, when you look at price under the 20-day EMA, like I was saying, the Fibonacci level is there, and now when you look at that, there's a declining tops line to have to deal with too. So it's going to be pretty strong.
Right, and again, we've had a huge rally within the last 6 trading days, but we still have a long way to go before we ever recapture that high. And just don't see it happening.
Mm-hmm. It's also a good point. We're seeing, and it's right here, the market may have touched down, below that 35% level. But as you noted on the other chart, it will require a 50% plus move to make up for that decline of that amount of money. So again, not all investors think that way.
And here we did get below the rising trend line, but ended up, we're right now above that rising trend line for the secular bull market. And also we got back above this line of resistance, which is now support. But I don't think we've restored the bull market at this point.
And there's the chart talking about bargains.
Right, bargain hunting. Right now, it has rallied, and we're back up at the top of the value range. This is where the S&P 500 would be if it were overvalued at a PE of 20. This is fair valued with a PE of 15, and undervalued with a PE of 10. So we're going to get final earnings on Q4 2019 within a few days here. And we're not going to see any, we may see a little downtick here. We're not going to see a real contraction on these bands until perhaps the middle, maybe for at least a month. I think it's going to take that long for us to start seeing estimates for fourth quarter of this year that will bring these bands down, but they're coming down, that's for sure.
Mm-hmm.
So when they come down, if the market were to stay here, for example, and this drops to here, well, then it's once again insanely overvalued when it's that far above the normal range. Did I have one more? Yes, the yield array again. Maybe I shouldn't show this as often as I do, but the rates are remaining compressed. They're compressed. I've not seen it like this before, except when you're way up here. But then when you're way up here, you have time, you have space to drop and for them to spread out again. But they didn't spread out this time. See, this is basically, we have no cushion in this area at all at this point.
Yeah, we could look at 2009 on through and see them just staying there.
Right. That was a horrible period. We finally started getting decent rates again, and now it's well, there you go. I wanted to show crude oil briefly. We did get below $20 a barrel today, intraday, and it did close slightly above $20. It doesn't look like it's down over 6.5% today. That's just that little move there. So that's how the context of this has just been expanded immensely.
Yeah, and you can't even see support levels.
No. Oh, that's right. I did want to show support levels. I forgot. Here we are. $17 looks like, I came along, found the bottom of this area of congestion, and that's $17. 10 is the all-time long-term champ in terms of low prices that we have a history for. But who would believe it?
I know. And I know that a lot of people, again, trying to find those bargains when it got down to that, $33 level, certainly when it got under $30, a lot of people trying to jump in there. But there you go. This is the issue. You can't trust any of these support levels right now in a bear market. You just have to be really
right.
attentive.
When we talk about inflation, depression and recession. This is an example of how depression works. Deflation works. You have plenty of supply and no demand, and that's essentially what we've got right now, and it's driving prices down. And of course, the Saudis and Russians aren't helping the situation, but I'm not sure it would be a lot better if they were out of the equation.
Sure. And that's,
Okay.
kind of brings up, we'll talk about it near the end. I'll let you go. Keep going.
Okay, over to the real estate discussion. Okay, real estate has dropped, the real estate sector has dropped 40%. And we've rebounded, but I don't think that's the end of this bear market either. I've just got some lined up here. Here's the go short real estate with this one. it's gone as high as 64% during this recent real estate crash.
Mm.
This is another area, 51%, 52% down for home builders. That's just crazy.
Yeah.
Of course, we got to bounce, but that's not.
Yeah, and it looks like a bull flag, but
Yeah,
it's bear market.
right. This is another. I read an article maybe a year and a half, 2 years ago about how, okay, malls are in trouble, but there are A malls. These are the high-end, high-class malls, and they should do pretty well. As you see, they are not doing very well. This is one of these A mall companies. It's a REIT, and they're down from their high in 2016. They're down over 90%, which doesn't leave a lot of hope for this particular company. And but this is happening. Not this great of a crash, but it's happening with other of these A malls. And here's what we got next. Here's this is the largest REIT that there is, and it's down 67% from its high, or what it got down that it's bounced, but it's coming back to test that. I'm fairly sure.
Mm-hmm.
And it's got to look at the yield.
I'm looking just even at that OBV bottoms. You can see they were declining, and yet we had rising bottoms on price. That's not
right.
Good.
Here, notice we've got the great dividend. Here's the dividend, and here's the earnings per share right now. The big worry about these REITs is, okay, well, we've had a truce on rent collecting and mortgage paying, so there goes their income.
Right.
It's just it's a zero-sum game. You can't take it away from Peter and give it to Paul without Peter suffering, and that's just what's happening now. In spite of all they're doing their best, but I just don't think it's going to be good enough.
Mm-hmm.
See, how many more do I have here? Okay, new residential. This is
Oh my goodness.
REIT. Yeah, it's down 75%. And then did we look at the home builders?
I think you did, yeah.
Yeah, that's way down. So
Mm-hmm.
this is quite a mess.
Absolutely is. I'm going to steal it back, and we can talk a little bit about recession and depression, and certainly would want your input on that, because obviously I haven't been through some of this. So let's go ahead and look. And I just pulled this up, off the internet, and it's two basics. So you've got a recession, which is a contraction of the business cycle. Well, obviously, we're going to experience that. We are experiencing. And, also a common rule is that you get 2 quarters of negative GDP growth. Well, I think we can agree that that's probably going to happen. But what about depression? And this is the thing that I think people haven't really thought about, is it's a prolonged period of a recession. And I suspect we're going to be looking at a prolonged period. It's marked by a significant decline in income and employment. That's what you look for. That's what typically is in a depression. I think we can agree that, we're going to still see a lot of unemployment. And let's just say things start to come back, the market bottoms, all of that. Everybody's saying, oh, it's going to come back. Everybody's the pent up demand and all of this. I disagree. I think that what's going to happen is people have, like I would guess, the boomers and those who lived through the Depression, did, you become savers. You don't become a spender after something like this. And that's not going to, goose things if people aren't spending. And if they don't have a job or an income, of course, they can't be spending. So I think this is just part of the puzzle, or what we're looking at that I don't think people have really thought too much about. What do you say?
Yeah, no, I didn't live through the Depression.
Right, right.
I
But
was
you
born.
experienced
I
like
was
what your parents did after because of it.
right. I mean, people were savers. They saved string. My mother saved plastic bags. The stuff the vegetables come in. She
Hmm.
washed them,
Yeah,
dried them. I mean, it was just people were tight. They were, because they had lived through times that were tough, and we haven't had a time like that for forever. Of course,
right,
we haven't anything like the Great Depression for any time, and it's not a it's not it's not something we're going to spring back from. This, even if the best thing happens, it's going to take months for things to get back to semi-normal. And in spite of all the money they've dumped on the economy, there are a lot of people that are not going to benefit from that because they're not going to get a check. Their job is not going to come back. We can't keep dumping money like this. They're going to get it in 3 weeks, and in a month that money will be gone. And so then what?
right.
We can hope that it's going to spring back quickly, but it's just going to take some time.
Right. And that's the thing, we're talking about changes in supply chains that could be helpful. Um, we've got things that are out there that could help with this, but it's just, I think the biggest indicator, if you will, is going to be the income and employment. I think that's really going to be the serious pressure on the market. And, I don't see pent up demand. I see that deflation setting up, because like we were looking at that oil chart, you're going to have a lot of supply and not enough demand, and that brings the prices down, which also is a good point, is that what are the best things when you're in a recession, depression, is cash is king. I'm guessing, again, I didn't live through it or experience, and you did not either, but my sense is that because nobody was spending that money, it keeps things going in that direction. It doesn't help.
And usually the government doesn't help the situation.
Right, right.
Um,
And we can get some help. I mean, we keep talking about, there's phase 3, phase 4, all of that, but ultimately, people need to have jobs. We can't just feed checks. That's just not necessarily going to, be what we need. It'll get people by, and hopefully, the good thing is we need to have people keep their jobs so that when this does end, that people do have something to go back to.
yeah, and again, the government not helping is like I've mentioned before, is that during the last real estate crash, the government stepped in, lowered interest rates, and goosed those real estate prices back up. But that was just one of those things that's a zero sum. You can't do that. They had to take it away from someplace else, and the rates, the prices didn't get back up there by themselves.
Exactly.
And
All right.
that's
Well, we got to cut this off. We really appreciate you joining us. Stay well, stay healthy, stay smart, and happy trading.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.